I'm Richard Pennell and welcome to the Mortgage Home channel. We are your buy-to-let mortgage and insurance experts. And in this video, I want to talk about the recent Bank of England rate reduction. And far more important than that, what does it mean for you as landlords and in terms of mortgages? What are the lenders doing? How have they responded? Now, before I get into the detail, if you haven't done already, please, somewhere around this video, there'll be a subscribe button. I'd really appreciate if you would click that subscribe and like. It gives us that feedback that you're actually enjoying the content and we're getting it right. So that would be much appreciated. Okay, let's get into the detail. So early February, the Bank of England met and they voted to reduce the rate from 4.75 to 4.5. Fantastic news. And in fact, if you get below the surface, the vote was 7-2 in favour of a rate reduction, which is amazing. But actually, more amazing than that is that 2 of those 7 wanted to drop the rate by 0.5%. Now, that tells me that the metrics are starting to line up a little bit more and give confidence to the decision makers to really push forward on rate reductions this year. Yes, inflation's going in the wrong direction, but that's all understood. It's really focused in on energy. It's not a widespread issue that's causing inflation to rise. And yes, it will rise this year, but as we get into 2026, it's expected to fall back down. So how are lenders reacting? Well, first of all, let's just rewind to January. Now, in January, I noticed that lenders were sat on their hands. They weren't touching rates at all. And why was that? Because I think organically there was significant applications going in without the lenders having to lift a finger or stimulate the market at all. And that's because the stamp duty changes at the end of March. So all the purchasers, they were desperate to get those applications in to give everyone a fighting chance of getting them over the line so they could obviously pay the lower stamp duty fees. As we've come into February, that ship sailed, frankly. And so to ensure that demand doesn't slow down too much, the lenders are now having to stimulate the market. So they're coming off the fence and they're now responding by dropping rates, cutting their margins. And of course, that's really been helped with the Bank of England rate drop thrown into the mix as well. So I'm seeing pretty much across the board, whether we're talking about the high street guys, the banks and the building societies, or the non-high street lenders, they're all pretty much doing the same and dropping rates by 0.2, 0.3 across the board. So really, really good news for landlords. And you might even say a little bit of a price war starting to make sure that depending on what lender you are, you're featuring high up in the league tables. So really positive stuff that I'm seeing. So what I've done to try and translate that generic feedback to you to actual rates is I pulled out what I see as the best. Now, I'm going to define what I mean by the best in a second, but the best 2-year and 5-year fixed rates right now, so you get a real flavour of what's out there. So straight away, lowest 5-year fixed rate, BM Solutions, otherwise known as their Sunday name, Birmingham Midshires. Now, I've done all these products at 75% loan to value. So please bear that in mind, because if you've got more equity in there, and if you're going towards a 60% loan to value, you might even get better rates than what I'm saying. So treat all this with a little pinch of salt. But let's work through it. So the best rate out there right now, 3.94%. So yes, we're under that 4% figure, but it does come with an arrangement fee of 3%. Now, if we allocate that arrangement fee over the 5 years, that's a 0.6% add-on to that interest rate. So more realistically for you and I to compare, we're looking around just over 4.5% as a true rate that you'd be paying for those 5 years. So that's realistically where we are right now. Now, as you can see on bullet point 5, there's a caveat here, in that you have to have an EPC rating on your property of A to C. And of course, I'm really, really mindful that there's a significant number of landlords where your rating will be D or below. So I've got another product to show you that doesn't have that restriction on in a second. However, it's made me think. If you haven't subscribed, please do, because the next video that I'll be dropping is about the looming prospective EPC reforms and what shockers are out there. Because if Labour do push this through, there's some massive changes that you really need to be aware of. So do look out for that next video. It'll drop in about a week's time about the prospective EPC changes and what that means for you. Right, back to today's script. So we've got BM Solutions there, but with that restriction that you've got to have an A to C. So if you're a D or below, and there's about 2.5 million of you, so this is going to be really relevant. We've got TMW, the Mortgage Works, owned by Nationwide, 100% ownership. Again, as I said, 75% loan to value. The rate's 3.98, so it's only 0.04 different to the BM one, so pretty much identical. 3% arrangement fee, so we're now up at 4.58. So very similar. That's about the lowest aggregate sort of rate you're going to pay when we're looking at best value for money. Now, you might be saying, well, Richard, I don't want to commit for 5 years. Get that. There's a lot of people that want to only commit for 2, so they get that option to review at that point. So I've also looked at the 2-year deals. Now, there's a company called CHL. If you've been around for a little while, like I have, then you'll know Capital Home Loans. I've actually were around 20 odd years ago, but sadly they fell victim to the financial crash 2008, but they resurfaced about 10 years ago. So they're not a new kid on the block. They've been around and they've been certainly back in the market now for over 10 years. And we as brokers use them very regularly, and they're really good supporters of the buy-to-let market. Now, they've got a deal, 2.96, which sounds amazing, doesn't it, on the surface? But wow, what a massive arrangement fee, 7%. And you might be saying, why on earth you're putting that up here, Richard? Surely no one would be foolish enough to take a deal with such a large arrangement fee. But hold on a minute. There's many landlords out there who their best deal that they want is all about cash flow. So they don't, relatively speaking, care, or it's a lower priority what the arrangement fee, because the arrangement fee is not a cash fee, it's added onto the debt. So with some landlords, they're willing to compromise and give away more equity by adding that extra 7% onto the overall debt, and they'll pay that back in the longer term, because in the short term it's an absolute priority to improve their cash flow. If you can't pay your bills right now, or you're struggling to keep your head above water financially, then this deal may well suit you. So 2.96 converts into an extremely low monthly payment. And if that helps to put a little bit more money in your pocket and make sure you can meet your financial obligations, then for some landlords, that this product would actually suit them. But I get for lots of you, you'll be saying, no way, that's not for me. And so what I've also done on the next slide is a 2-year deal that's what I would call the overall best value for money. So what it does, it takes into account not only a good competitive rate, but the fees, and looking at the combination of two is then the lowest cost to you as a landlord. So let's move across to the next one. The last thing I've got to say on this before I move on, 6.46 is the pay rate that it converts. So yes, it's high, but it still might be relevant for some of you landlords out there. Okay, if we want best value for money, then actually right now we should be looking at Santander. So again, at 75% loan to value, we're getting under 5%, 4.96, no arrangement fee, no valuation fee. So that is essentially the pay rate, just under 5%. But looking back to the 5-year deals, what we're therefore seeing is that the 2-year fixed rates are still 0.4, 0.5% higher than a 5-year fixed. So the overall takeaway from this is that lenders are still pricing their 5-year deals cheaper for obvious reasons. They want you to commit for longer than the 2-year ones. And we've got about a 0.4 differential. However, as we get through the year, my prediction is that that gap should start to get smaller as we go. And hopefully we'll see that balancing up. To me, that's long-term what we would have seen historically hopefully we'll get to see that again. Now, got to put some warning signs. Look, this isn't advice. You may not be eligible for these deals. So please, 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 if you are interested in anything that's just been raised today in this video, then in the comment section below will be a link to our online diary. Book some time in. It's free. It's no obligation. Have a more of an in-depth chat with the team. See if these are relevant for you. Or, as I said earlier, there are actually some better deals if we can get the loan to value down. As I said, these are all at 75% loan to value. Hope that's been of use to you. Have a great day.